In this video, we're going to continue talking about dividends and how managers decide how much to pay out. So let's think about this perfect capital market. A firm's free cash flow determines the level of payouts. We've talked about free cash flow several times in many videos. So in a perfect capital market, the type of payout is irrelevant. In reality, though, we know that capital markets are not perfect, and we need to understand those imperfections to understand how they might influence the firm's payout policy. So first, let's talk about taxes. So shareholders obviously pay taxes on dividends. They also have to pay taxes on capital gains. Now, your textbook says that dividends are typically taxed at a higher rate than capital gains. That's not currently true. They are typically the same. It's based on your income, but there are three basic tax rates, 0, 15, and 20, depending on your tax rate, and the criterion for those tax rates, or those levels of income, if you will, are all the same. However, since you do not pay capital gains until you sell the asset, the tax rate is effectively 0 on capital gains until that time. So I guess it is sort of true. Shareholders do pay a higher tax, but it's not because of the rate. It's because of the deferral of capital gains taxation. So since we have a higher tax rate on dividends, it's undesirable to try to raise money to pay a dividend, right? So again, if dividends are taxed at a higher rate, if a company raises money, let's say issuing shares, and again gives that money back to the shareholders as a dividend, because they pay a tax, they actually receive less than their initial investment. So the idea here is that taxes are a disadvantage if a company is paying dividends. So when the tax rate on dividends is greater than the tax rate on capital gains, shareholders pay lower taxes if the firm uses repurchases. So that tax savings increases the value of a firm if they use a share repurchase rather than a dividend. So the optimal dividend policy, if dividend tax rate's greater than the capital gains rate, is to pay no dividends at all, right? So again, if you look at history, it appears that payments have declined on average over 30 years. I'm not certain that, if you look at the picture, I'm not so certain how relevant that is, especially if you look at the last couple of years since 2010. Companies paying dividends has increased, while companies buying back stock has been rather flat. So I'm not sure exactly what they're trying to tell us with respect to this. I don't know. And again, when you think about if companies are paying, just because more companies are paying dividends, that doesn't mean that dividends themselves have increased. It just means maybe more people are paying dividends, but they're paying lower dividends out. So their representation that this is somehow driving this particular picture that I think is misleading, I don't know how to explain that. So it appears then that there is a preference for share repurchases rather than dividends. Now, what do we know? We know that tax rates can vary, right? We know that it's different by jurisdiction. It's what happens if a majority of your shareholders own this stock, but the stock is all owned in 401ks and IRAs. Then there's no taxes paid anyhow, dividend or capital gains, until later. So There's lots of reasons why this might attract different groups. So that leads us to thinking about something called a clientele effect, right? Where the company is going to maybe attract people that want certain kinds of returns, not amounts of returns. So let's first start talking about the effective dividend tax rate. And just to kind of cut the chase, right? So the difference between before and after the dividend payout rate, right? The record date, the actual difference between those two prices is the dividend multiplied by the change based on the tax code, right? So T sub D is the dividend tax rate. So how does that influence this overall formula? So if you look at the difference between the tax on dividends and the capital gains tax, again, that's what this T sub D with the star is. It's the effective tax rate. It depends on this difference. Now, we now know what? If you don't sell the stock, T sub G is 0. So that means what? T sub D is just the tax that you pay on dividends, right? So right now, that's what? Depends on who you are, but it could be 0, 15, or 20. So again, there could be an influence. The wealthier you are, the less effective dividend that you actually receive. So again, as this mentioned, it differs based on your income level, investment horizon, type of investor. So different investors have different preferences regarding dividends. And I kind of like to think of it not just preferences regarding dividends, but let's say you had two companies, both of them paid 10%. They're identical twin companies. They both pay 10%. So if they're identical companies, you shouldn't care which 10% you get. But if one, you get 10% in dividends, and the other, you get 10% in capital gains, then maybe it does make a difference which one you want. Because if you get the 10% in dividends, you're now facing the effective tax rate, which you're going to have to pay taxes. Now, if dividends is what you want, right, maybe that's the kind of company you want, right? But the other company, you're not going to pay any taxes until you sell the asset. So typically, wealthier people are going to be attracted to the company that doesn't pay dividends, right? Everything comes in form of capital gains, where retired people, lower income people are going to be attracted to the dividend companies because even though they actually receive less of the dividends, they are attracted to that rate, right? The cash flow that they want to receive. So the clientele effect basically lays this out, right? It says people that have the highest tax rate have a preference for stocks that don't pay dividends, right? So it would seem then that if a company changes its dividend policy, all it does is change investors, right? There'd be no change in the supply and demand curve, so there'd be no change in price. All that would happen is the company would be changing the owners of the company. And the company, quite frankly, doesn't care who owns it as long as somebody buys it, right? So that's really the only importance to the corporation is that somebody buys the shares. So now let's think about the difference between payout versus retention of cash. In a perfect capital market, once the company has taken all of the positive net present value investments, it then doesn't care what happens to the money. They can either save it or pay it out. It doesn't matter. But with market imperfection, there's a trade-off. Retaining cash can reduce the cost of raising capital in the future, but it can also increase taxes and agency costs. So there are market imperfections that do affect the retention of cash. So again, if a company has already taken all the positive net present value projects, any additional projects then by definition have either zero or negative net present value. Rather than waste excess cash on negative net present value, a company can use the cash to purchase financial investments. Now we know that those are zero net gain kinds of transactions, but at least the money is there and not wasted. And we've talked about this, right? So in a perfect capital markets, buying and selling is a zero net present value transaction, so it won't affect the firm. So again, with perfect capital markets, the idea is it really is irrelevant what the company does with this extra money. And again, we keep repeating these things, but it just kind of important, I guess, to kind of reiterate, right? So again, in perfect capital markets, if you invest excess cash flows in financial securities, the choice of payout, retention, or payout, it's irrelevant, and it doesn't affect the share price. So what about taxes and cash retention? So corporate taxes make it expensive to retain excess cash. Essentially, what we're saying here is that cash is like negative leverage. It's borrowed money, but there's no return on it. So essentially, it has a negative tax advantage to the company. So there is a disadvantage to holding cash from a tax perspective. So the decision to pay out versus retain can also affect the taxes paid by shareholders. We've talked about this. If they retain cash, it has to pay a corporate tax on the interest it earns. In addition, investors are going to owe capital gains on any increased value. So in essence, if you retain cash, this retained cash is taxed twice, right? Once at the corporate level, and then once on the increased value to the company. So I think this might be a little confusing, right? It's not terribly clear here, but essentially what we're saying is that this idea that the dividend decision is irrelevant really doesn't hold in real life. Taxes are important. The investments that you can make are important. So all of these things have importance for understanding how management is going to decide to pay or not pay, or if they're going to pay, how much to pay. So we'll talk about this in the next video when we conclude our discussion on dividends. Talk to you soon.